Look, picture this for a second. You wake up, you check your bank app, and the number is fine. Not great, not terrible. You're paying your bills, you're making your minimums, maybe you're even investing a little. And yet somehow you still feel like you're losing. You're working harder, you're stressing more, and every year money feels more in control of you than you are of it. Here's the uncomfortable truth. It's not because you're bad with money. It's because a massive part of the financial system you're living inside doesn't play by the same rules you think it does, and almost nobody explains that part. We're taught a clean, comforting story about banking. Banks take deposits, banks make loans, banks are regulated. Money flows in predictable, boring ways. That story is outdated. Banks aren't the most powerful institutions in the system. They're the front desk. The real action happens somewhere else, in something called the shadow banking system. And before you tune out because that sounds technical, stay with me, because this affects your checking account, your credit card interest, your mortgage rate, and your job security more than you realize. Here's a number that should stop you cold. Globally, the shadow banking system controls over $60 trillion. In the US alone, it rivals traditional banks in size, and most Americans couldn't name a single institution inside it. That's not accidental. Shadow banks don't take deposits directly from you. They don't have branches, they don't have friendly apps, they don't explain themselves to you. They operate through money market funds, hedge funds, private credit firms, repo markets, and structured vehicles most people never see. Here's what they actually do. They borrow short-term money. They lend long-term money. They stack leverage. They chase yield. And they do it with fewer capital requirements and less scrutiny than traditional banks, which means they can move faster. They can take bigger risks. And when it works, profits explode. When it doesn't, that's when things get interesting. Now you might be thinking, how does this affect me? I don't invest in hedge funds. Here's what most people don't realize. Your money is constantly being used as raw material for the system. You deposit $10,000. You think it's just sitting there. It's not. That deposit becomes collateral. That collateral supports lending. That lending gets bundled and moved into short-term markets. So your $10,000 might indirectly support $50,000 of lending, which supports leveraged trades somewhere else. And you never see the upside. Now let's talk math. Let's say you keep $50,000 in a savings account, earning 0.5%. That's $250 a year. Feels safe. Meanwhile, that same capital can be deployed in institutional structures, earning 6 to 8%. Let's say 7%. That's $3,500 a year. You get $250. They capture the remaining $3,225 every year. Over 10 years, that difference isn't just $32,500 because returns compound. The opportunity cost can exceed $40,000 to $50,000 over a decade. This isn't conspiracy. It's spread extraction by design. Behavioral finance explains why most people stay stuck. Humans overweight visible risk and underweight invisible cost. You can feel a 10% market drop. You can't feel 8% inflation quietly eroding purchasing power. You panic during volatility. You ignore silent stagnation. So you stay still and the system moves around you. Halfway through this video, I want to ask you something honestly. When you think about your money right now, do you feel in control or monitored? Drop a comment below. And if this is helping you connect dots you didn't even know were connected, subscribe. This channel exists for people who want clarity, not comfort. Let me tell you about someone I'll call Mike. Mid-30s, stable job, responsible. Did everything right. He had about $80,000 sitting across savings and low-risk funds. He told me, I don't want to risk it. I just want stability. 3 years later, inflation spikes. Rates jump. Mike didn't lose money on paper, but he lost over 10% in purchasing power. That's $8,000 quietly gone. He didn't break the rules. He followed them. Institutions adjusted yields immediately, protected margins, captured upside. Mike felt like the rules changed. They didn't. He just wasn't playing the same game. Most people don't lose because they're irresponsible. They lose because they don't see clearly. A few years ago, I realized I was drifting financially. Money sitting idle, decisions reactive instead of intentional. So I built something for myself called the Life Control Pack. Not as a gimmick, as a visibility system. I use it to see where my cash is idle, to force intentional weekly decisions, to track habits that align with what I say I want. Nothing complicated, just structure. If you're serious about not drifting financially, you need some kind of clarity system. This is the one I use. If it helps you, it's linked in the description. Now, some people will say, didn't shadow banking contribute to the 2008 crisis? Yes, and that's the point. When these systems work, profits are private. When they break, losses are socialized. Millions lost homes. Liquidity was backstopped, and the system didn't shrink. It grew, because capital always looks for yield, and regulation always lags innovation. You don't need to become a hedge fund. You need to ask better questions. Where is my money sitting? What is it actually earning? What risks am I avoiding? And which invisible costs am I silently accepting? Who benefits from my inaction? Awareness isn't radical. It's defensive intelligence. Let's go back to that moment. You check your bank app. The number looks fine, but something feels off. That feeling isn't anxiety. It's unprocessed information. The system isn't evil. It's efficient. And efficiency doesn't care how hard you work. It cares how aware you are. If you've watched this far, you're not looking for comfort. You're looking for control. If you're serious about building structure instead of drifting financially, the system I personally use is linked below. And remember, invisibility is expensive.